Welcome to today's webinar, Navigating the New Banking Landscape, Strategies and Solutions with John Winick at Clark Street Capital. John, you've put together another all-star program. This is awesome. We have Chris Marinac, Director of Research of Janney, Jason Kuwayama of Godfrey and Kahn, and Edward Hida of Secura. I don't know if I got those names pronounced right, but I'm going to go with them. John, these events are great. You attract a lot of people. You do great content. Before we start, I want to introduce you a little bit. You're the founder, president of Clark Street Capital, who facilitates transactions between lenders. You started a great program a couple months ago called Accelerated Band, which greatly increases the speed that these transactions be closed. Briefly tell us about that. And I know they're for small, usually single purpose assets. Tell us about that real quick before we get started.
Yeah, it's an opportunity for a bank. Now it's March 12th, and if you want to sell a loan by quarter end, perhaps you've got some room in the charge-off budget. Perhaps you're trying to comply with your ratios. And we've designed a process where instead of a typical 5 to 8 week process for loan sales, it's 1 week for bids, 1 week to close. So it's generally designed for smaller deals.
Very good. Please ask your questions, put them in chat. John will cycle those in during the presentation. This also will be streamed on YouTube. You can view this later at your leisure and send it to anybody you want to. And with that, John, I'm going to turn this over to you, and I want you to give us an update on what is happening in banking.
Absolutely. Well, to start us off, I'm going to introduce Christopher Marinac with a banking and credit update for first quarter 2024.
All right, John, thank you very much. Appreciate the opportunity to be with everyone today. We are looking at the pros and cons of banking in early 2024. I have the mantra of we need less attitude and a little more gratitude. The banking industry is a much better footing than it's currently understood. This starts with tangible book value growing, excluding AOCI marks, about 6.6%. In 2023, we had a lot of companies grow book value last year, and when you take out the mark-to-market of securities losses, which are largely unrealized and largely government-based, we continue to see book value growing pretty close to the 7% long-term annual average. Credit quality is certainly worse than it was at the very lows of 2021 and 2022, but worse is really a matter of opinion because we still have very low numbers in the industry. As we show you some of our graphs, there's a low amount of past dues and problem loans in the industry. What's really changing is some of the risk-graded ratings that banks are doing. We'll get into that today. One of the things that we see a lot is a bunch of headlines and negativity and misinformation that is really missing what's actually happening. We have low leverage in the banking industry. Banks are lending at 60, 65 cents on the dollar, not 95 to 105 like they were in 2007 and 8. They have more equity in deals. Therefore, they're going to have less losses as time passes. We do think there are problems. We do think there are losses. The question is how much? What's kind of different today is that debt service coverage is a key topic with the regulators. They're enforcing a very strict definition of DSCR. It's leading banks to downgrade loans from a pass rated to a non-pass or criticized status that is growing reserves, a little bit of charge-offs, but primarily it's just recognizing that there's a potential for risk down the road as interest rates rise. Debt service coverage ratios are being recalculated because of higher interest rates and the attitude that you're going to have to refinance at higher rates than loans were originated back in 2020, 21, and 22. We also think that banks have an excellent PPNR, operating cash flow. PPNR is pre-tax, pre-provision revenues. It's the cornerstone of the stress testing that banks have been doing for several years. It really is the operating cash flow that banks can use to fund future reserves. We think it's actually very strong today, because banks still have a lot of loans that are performing on the books. They also have cut expenses over the years. They have a little bit more fee income. They're just in a better health than they were pre the great financial crisis 15 or 16 years ago. As we transition to what's happening in the business, we have a couple graphs here that John can elaborate on. So John, step in whenever you like. We think that fundamentally the business is in really good shape today. And if anything, what we have to remember is that we are going to see deterioration. We do think that there's going to be higher problems to be dealt with. It's simply that the industry is coming at it from a much better position of strength. We have some data in the slides today that just talk about where securities values are. We had an improvement at year end. We'll probably see some of that have a little bit of deterioration because interest rates are up for the first quarter. But remember that most banks' securities tend to repay over many years. They were on a 5 to 6 year duration. Those may have extended a little bit, but there definitely is a chunk of bank securities that naturally pay off every year. I would say it's about 8 to 10%, depends on how much you have in the residential mortgage backs. If you have more or less mortgage backs, that's going to drive how much is amortizing every year, but it is not zero. It is definitely some. So these issues on securities are going to look better and better over time. And banks are also beginning to slowly restructure a little bit of their securities portfolio to get higher yield. Those restructurings have been small, but they were starting.
And Chris, is there much of a difference in the securities books between the large banks and the regionals and the community banks? What sort of differences are you seeing?
I mean, if you look at the smallest community banks, they tend to have more munis, but that's a real generalization, John. I think a lot of banks own the same mixture, which is roughly 35 to 40% mortgage backs, 10 or 15, maybe 20% of treasuries. And then you have a mix of everything else that could be a little bit of sub debt, certainly some CMBS, some CLOs in the portfolio. They tend to all be government agency driven for 90-95% of the portfolio. So to me, the risk of loss is much more limited and to some extent more theoretical, because most banks are intending to keep these portfolios until they pay off. And then banks are using their portfolios to use as collateral for borrowing. And they're still borrowing from the FHLB. They borrowed to the BTFP, but the BTFP is going away. And it's there. I don't see a problem in the industry. We still have the amount of overall leverage in terms of bank borrowing still being half of what it was during the great financial crisis.
Chris, do you think that if the proposed rules on capital for 100 billion and larger banks, at some point come into effect, I know they phase in terms of the ratios. What do you think that will do in terms of, in essence, the security AOCI allocations and the losses for allocations as those free up? I mean, they really get grabbed back, don't they?
They do. In fact, I think you're seeing is that those calculations are already better a year later, because banks generally made money and grew capital in 2023. And then you have this natural amortization of security. So it's already on its way. And then you have the phase-in period. So by the time 26 and 27 roll around and you officially have the new definition of CET1, I don't think it's going to be a big issue. Now, of course, the big debate is that banks have got massive problems and they're going to have to write everything off and it's all going to happen at once. And I disagree with that. I think that you have few cliff events in credit. You tend to have more natural progression of deterioration, and I think that will bear itself out. I think banks are also reserving right now, and they've built reserves, and they'll continue to do that to work themselves through the mess. And to some extent, I think we're going to find that banks' loss rates are not going to be as ugly. But for the moment, we're going to worry about that and prove it wrong later. Banks will continue to grow reserves, but I don't think the capital ratios have any particular pressure. The question just is, are we looking at them all being adjusted today, or are we looking at them, in 1 year, 2 years? And that becomes a definition. Held to maturity is not part of the capital rule. So that mark to market for HTM is not going to count. It's only the AOCI from available for sale.
Yeah, Chris, couple of things. I think the bank term funding program actually expired yesterday. So, we're kind of out of that regime, which I think could actually have some other effects, given that, while wasn't hugely used, if you will, on kind of a statistic basis, certainly there was funding in it and, a source of liquidity, which, helps, banks, relative to this. And, I think one of the points you're making also is about the macro environment. And, we're kind of now in a apparently maybe even longer even higher for even longer. It's maybe a better way of saying it after, I think people at the beginning of the year expected rate cuts and all that. And, obviously it hasn't happened due to the inflation environment. I think we're still expecting some rate cuts, but, they're kind of getting pushed down the road, if you will. So it seems like this, elevated rate environment is going to persist longer than expected, which then would cause these, embedded, economic unrealized losses to sustain longer as well. So I think that's one factor. Another thing, and again, this is all in the unrealized world, but if you looked at loans, loans would have a similar effect if you looked at them on an economic basis. Now, clearly, we're not marking those to market and such, but if you purely looked at it on an economic basis, many of those would have been made at lower prevailing rates, and in the current higher rate environment, there would be, in effect, unrealized losses on the loan. So that's a further pressure to interest rate margin and things like that, where bank may have portfolios that have fair amounts of underwritten loans as well as securities at lower rates, and then now we're in this higher rate environment, and again expecting that higher rate environment to persist a little longer than we had. So I'm not calling doom and gloom by that, but I think some things to look at to maybe broaden this out a little bit as well.
Well,
Chris, at some point.
Sorry, Chris, go ahead. But Chris, go
I
ahead.
was just going to say, remember that banks have been building loan loss reserves since 2020. Most adopted the CECL accounting in 2020, and that has led to higher reserves. A lot of your bigger banks are sitting with reserves that are 140, 150, sometimes over 2%, depending on who they are. So there's been a fair amount of reserve building. I think there has been reserve building at the mid-cap banks just to a lower level because they're much more like 1.2 to 1.25. But there is a reserve that has grown, and you do have some ammunition to fight back on the marks. And certainly you're right. I mean, loan marks are there. I also think there's been loan turnover because a lot of loans in the commercial space are done on, 3 to 4 years average life. Yes, they may have a scheduled life of 5 years, but they tend to stay on the books closer to 4. There's a lot of C&I loans that are 3. So it kind of blends down. Pure real estate is going to be 5, but there's a lot of stuff done in 2020 and 21 that's rolling over in 25, 26, and some this year. The banks are not ignorant of this, and they're going to continue to throw more reserves against it. That's why the PP&R argument to me is so important. I think you're going to see banks have cash flow to kind of work their way out of their challenges. They're definitely not handicapped. They have a lot of cash to handle, and they already have reserves that have started. I think that's a better workout environment than folks realize. And then, of course, the leverage is key because you're starting off at 60 or 65 LTV, not at the former 90 to 100.
Yeah, but Chris, you said that regulators are really looking at DSCR, and around this time last year, the Fed had introduced some rules about criticized loans and allowing, with strong guarantor support and at least a 1.0 DSCR, assets to be modified in some way. And I think every bank, it was loose guidance. I think every bank interpreted that a little differently, but there are quite a few banks that interpret that as about a 1 year sort of forbearance or restructure of some kind without it being criticized. That would seem to be ending generally now to the next 3 months from now. Does that coincide with any increase in ALLL? I mean, are banks getting worried since we have this persistent interest rate environment that's high that we're not going to have DSCR at 1.0 or when they reset?
So, Jason, excellent question. I think it's already happened. I think it happened in the fourth quarter. I mean, you could argue that was exactly the issue that was acute to New York Community. I think New York Community was told they had to redo DSCRs and all the multifamily, and they had several loans that originally came on at 1.4, 1.5, and they were reset to 0.9 or 0.95, and they had to class or criticize those and put reserves against it, and it of course shocked the market. The management team lost confidence, and it continued to sort of play out for 6 weeks. That led to the capital raise last week, but the mechanics are all back to the DSCR. So will this continue to happen? Sure it will. I think you'll have more stress testing further down the road, and I think it will lead to higher criticized loans. That's the bad news. The good news is the banks, I think, can fight it with the cash flow they have. And frankly, that's where the capital comes in that banks have. I do think you'll see select capital raises occur. It's not going to be as ugly and as quick as it was during the great financial crisis, but there will be more capital raised. And, NYCB is not the only one out there that had this issue. I think that the market was panicked and had a lot of information about deposit flows that were actually stable, up until about the 1st of March. And then they struggled for 3 days and had to do something. And that was unfortunate, but that was also, some of their own errors and how they handled their situation.
Switching over to commercial real estate, as you can see from the chart, this actually takes you from the financial crisis, pre-financial crisis, where NPAs were at near record lows. You obviously can see the big spike there, probably peaked in early 2010. And you can see how low we got during the COVID years. And you are seeing a spike, but we're certainly a long way from 2008 scenario. If you look at banks from different asset sizes, you could see that there are more problems with the larger banks at this point, but that may simply be a function of more aggressive actions that they're taking as opposed to some of the smaller institutions. But this is a great example. I mean, this is the crux of the CRE problem. Great example here, $15 million loan. Assume the NOI is $1,175,000 at a 3.5% interest rate, 30-year amortization, which would be aggressive amortization, but not uncommon. The debt service coverage would be 1.45 times. So that would be a good loan. There'd be a cushion there. And now let's just say that loan comes up for maturity today. Assume the NOI has been stable. And you could see that our debt service coverage drops below 1-to-1. Now, when you look at this particular deal, my guess is there'll have to be some cash in refi here. The borrower will have to bring, 20% to the table of their equity to right-size this loan. But again, someone said commercial real estate is idiosyncratic. I tend to agree. This could be a good loan with a good sponsor, and this could be a loan that heads into trouble with a bad sponsor. So, it's a case-by-case thing. Chris, why don't you cover some of what you see in the SEC filings?
Yep. So one of the points that is incredibly important is in 2013, the SEC asked banks to give more details about their loan portfolio. This is post-financial crisis, obviously. And the easiest answer was to present the internal risk grade systems that banks have been using for decades. It's the, pass and non-pass, and then criticized versus performing loans. And what we found is that schedule has become more and more robust over the years. It started with hotels and other available information during COVID, and now a couple years later, it's really getting detailed in terms of CRE, C&I, particularly, and then more color coming from office real estate and other CRE buckets. What you find here is this is our handiwork at Janney, where we went through the 10Ks, looked at how the companies disclosed their pass and non-pass loans, and then counted everything up to get a whole portfolio number. So at B of A and at JP Morgan are up quarter over quarter, but they're modest. They're 3% and change. As you fast forward to a Fifth Third, a First Horizon, they're bigger. Huntington, bigger. NYCB is not on this list, but they initially said that their numbers are around 6.25, up from 4.0. That was what disturbed the marketplace 7 weeks ago. And then when you go from the whole portfolio, which does include consumer, past dues, and non-accruals, you get to just the CRE, you can see some big numbers here. You can see that a U.S. Bank and Wells Fargo around 12%, Bank America 12%, Huntington 15%. NYCB is 14 from what they said back on January 31st. Those high CRE are all a function of this disconnect between debt service coverage at origination and DSCRs today in today's market and stressing those loans.
Chris, does that include, are they breaking out owner-occupied commercial real estate from non-owner-occupied?
They do in certain cases, John. It depends on the company. Most banks are giving you owner-occupied and non-owner-occupied at the criticized level. It just depends on how the company's scheduled, but more often than not, you do have the difference. And then we presented the C&I because the C&I numbers are worth knowing too, just because C&I tends to have higher loss content as you go through a recession. Today, the C&I loss content's not much, but I think it does get worse as time passes. And then we gave some examples, New York Community here, and then another bank in New Jersey, where the disclosure on office and multifamily is becoming very good. It still is not perfect. We still need more detail, but you're getting a year-by-year maturity wall. And that's a really important data point that's coming out of these companies, where you know what's coming right at them in the next 2 years. And then we're asking companies to give us more details about the debt service coverage by year, the rate by year, the LTV by year. And that allows you to truly do a loss and a frequency and severity analysis to get behind how much reserves they need to kind of fight the fire.
Yeah,
That's
Chris,
what's happening at NYCB today. Go ahead.
what stands out here is the weighted average coupon at 3.85%. That clearly is probably 200 basis points at least below market.
Absolutely.
And, not only are they making enough money on this portfolio, but, clearly that debt service coverage will come down as you move to a more market coupon.
That is correct. And they'll make more money as they have new loans come in at higher yields. And frankly, NYCB has already signaled that they're going to, change their mix to have less real estate, more commercial, more consumer, and that will also help yields too. It's going to take, several quarters to get there. We gave multifamily schedule for a bank in New Jersey. We're having a lot of that information coming at us from all kinds of banks. Multifamily is probably the next layer of people's concern. I think it's a little early to get too negative on multifamily. I do think it's a source of reserve growth that has to happen. I do think it'll be more criticized loans. We're hearing all kinds of slow lease ups of multifamily. But I still think the occupancy is good overall. And generally speaking, I think the oversupply of multifamily is only in pockets. And generally, I think it can be absorbed, in 9 months' time. So we think there's need for reserves in multifamily. There's need for caution. All that's legit. I just don't think the loss content is going to be anywhere near what the worry is in office real estate. The office real estate is clear, and those banks who have it, will continue to sort of A, have to grow reserves, and B, have to work out properties sooner versus later.
So last week was the big news at NYCB. I think that their CEO, their prior CEO, will go down as one of the most effective one-week CEOs in history. As in 1 week, NYCB fired the existing management team. They hired new executives. They brought in 4 new board members, brought a new management team, and brought $1 billion in capital. Jason, obviously everyone would be concerned about this NYCB portfolio if you were going to put $1 billion into this bank. Can you give me some color on what you think those parties might have done, and some color on the NYCB investment?
Yeah, maybe I'm a counterculture kind of guy, but I don't know that everyone would be that worried about it unless you paid too much, right? In your investment. I mean, relative to book, their investment is a pretty steep discount. So their basis, if you will, leaves a lot of room for upside. They said some very interesting things. We think the book, the marks and the ALLL look fine. And I think that makes sense if you're an investor, right? If you're bringing $1 billion, you're not going to signal to the market that we're bringing $1 billion, and you know what? There's a lot of problems down the road, because you're going to hurt the share price, and you're going to stop future sort of investment in the bank. And so, I think they probably know more than the market does about some sort of burn down of the portfolio. I think, Chris, you would know better, but NYCB is restating on Friday. Is that right?
Well, they're following their 10K by Friday. They've already announced their restatement, which are minor details in terms of, some accounting items in terms of the gain they booked on Signature Bank, and then a couple other expenses. They had to write off their goodwill, which had nothing to do with their prior acquisitions in the last 2 years. It was more about stuff that happened 16 years ago. But that's GAAP accounting. When your stock price goes down, you test goodwill and then you write it off. It was a non-cash charge, but the market used that as a good excuse to be more negative on NYCB, not understanding, the GAAP impact.
Yeah, I just want to be hesitant to draw wide-ranging conclusions here. I mean, this is a bank investment. And years ago, after or during GFC 1.0, Citibank was under $1 a share, and it drew a lot of investment. People didn't think Citibank was going anywhere, and guess what? It didn't. And so, investors are shrewd. This group in particular is shrewd, has prior experience acquiring, I think it was IndyMac, and maybe investing in some other banks during GFC 1.0. I think they saw an opportunity to get in at a low basis. They see a lot of upside. My general impression, obviously, I don't know anything. I didn't represent them to make that caveat, but I don't know that they're in it for a significantly long time. I don't want to say it's a short investment, but I would expect there to be, some additional changes at NYCB in the next 5 years, if you will. That's my guess. That's my prediction. Who knows? But I just think you're going to see a lot more bank investment. Sub debt's too expensive, right? So way too expensive right now, and so it's going to come in the way of capital raises. And I think as investors see good opportunities with a little irrationality in the market because of a quick deposit leakage that was stemmed, or some announcement of a jump in your ALLL or in watch list credits, whatever, they see that, they get nervous. Investors are going to pounce on that. And I really think that's as simple as what happened here.
Yeah, I mean, I do think, Jason, that it's going to be a longer ride. Their goal to be 1/3 commercial real estate, 1/3 consumer, 1/3 C&I. I mean, they were 800% CRE prior to the Flagstar acquisition. They're close to 500 now. I mean, that's going to take a long time, especially given the coupons on these multifamily loans. Those borrowers aren't going anywhere.
Well, don't underestimate the power of large, balance sheet transfers, selling portfolios, selling divisions, and acquiring divisions in other portfolio's, right? You can realign a bank's portfolio fairly quickly if you have the capital.
Yeah, that's the point, though. Capital and, what are the valuations going to be on that portfolio? And I think, you're dealing with somewhat, you mentioned the word idiosyncratic before, which I think is really apropos in this situation when you've got the New York City rent stabilized apartments, and those things have some really unique characteristics there in terms of the restrictions on the landlords, the operators, to be able to raise rents and therefore service perhaps in a elevated rate environment. So I think there is a question about valuation and the portfolio and how that's going to play out. Clearly, I think, Jason, all the points you made about a sophisticated, informed investor group, are on the mark here. But, I'm not predicting, a path on this, but I do think there's a real hurdle on that portfolio, especially the multifamily, to some extent, CRE as well, and how that's going to play out over time. And yes, you can sell, but at what prices, and is that going to be attractive, or is it going to require more capital as well?
Yeah. Can we bring up the poll question? So very curious to the answer of this. Obviously, this is your own personal view. This isn't the institution view. But can we queue up the poll question? What is your personal view on NYCB?
Yeah, just one moment and we'll get that up.
Okay. While we're waiting for that to queue up, one thing that was interesting about this deal is my understanding the due diligence was fairly fast, less than a week. So they probably couldn't have done that deep dive on the portfolio in such a short period of time. And it does seem, Chris, from their presentation, they seem to be modeling as much as a $750 million addition to their loan loss reserve. So it does seem like they have a pretty good understanding of what the embedded losses are, but how deep did they actually dive is the question I would ask.
So John, they were asked about taking additional reserves given that illustration, and they said they weren't going to do that. I think the truth always comes a little bit in the middle. Management teams are known to fib before, so I think they wanted to illustrate what capital was going to look like, with and without additional reserves. The time will tell. Because they have the capital, they can do some flexibility and move assets. I would argue that you can seller finance assets under the regulatory guidelines and take lower losses. We had Capital One do that in the summer of 23. There's other portfolios out there that I think will trade this year that will have seller financing. It's totally legit within the OCC, Fed, and FDIC guidelines. You just have to do it the right way with the right parties that buy the assets. So I think there's a lot more optionality that they have. And again, capital really is the grease that helps this move along.
You know, my guess would be that group, that investor group, I think it was three equity funds, has a little dry powder, just, based on where they were in their initial investment, that if it comes down, as Chris was saying, where it's somewhere in the middle, I see the group probably working to make the investment before that additional reserve is made.
Yeah.
One other thing, John, I saw an interview with Mnuchin, and he said that they had been closely following the bank for several years, and they may have had prior conversations. So, clearly, that transaction happened, with a limited time window in a bit of a crisis, but it appears that they were knowledgeable about the bank for some time.
Well, we have a very good cross section of the investing public, because basically half are neutral, a quarter are bullish, a quarter are bearish, maybe slightly more bearish than bullish, but it's interesting. All right, switching gears. Jerome Powell made a stunning comment last week when he was before Congress. For background for everybody, the banks have not taken the new capital rules lying down. There's been an unprecedented lobbying campaign by banks to get the regulators to change these proposed rules. Powell said that 97% of the comments were unfavorable, and noted that was the highest they probably have ever seen to a proposed rule. So, and he did indicate that the agencies were taking those comments, they were backing off. Ed, any comments? I mean, what are you hearing? What do you think? How do you think this is going to play out?
Yeah, this is a really interesting one here for bank regulation and banks, especially probably a little more emphasis on mid to larger banks. But as you indicated, John, that Powell, kind of tipped his hand a bit in terms of what the expectation is around so-called Basel III endgame is really what we're talking about, is the term that's used, and really kind of a comprehensive rewrite of capital rules for banks. Unprecedented to some extent lobbying, if you will, but Latham Watkins actually is a firm that came up with a 97% opposed in terms of the comment letters. They analyzed all the comment letters that had come in. And one of the other things that I noticed in reading their report on this, of the letters coming in opposing the Basel III endgame, 86% were from people outside of the banking sector. So this wasn't just a case of, bankers all sort of ganging up and, finding something that, wasn't palatable to them. There's a lot of belief that, it would have an impact, on the economy. And, what Powell indicated was, he used the word broad and material changes, and it is a very substantive rule. So with objections, frankly, on many areas because of the impact of it. I think the question now becomes, what happens next, right? And so there's a couple options. One is that the rule has been proposed. They could make, the regulators could actually make modifications and then issue a final rule. That's one path. Powell indicated that he was open to a reproposal. Reproposal then would mean issuing a new proposed rule, which would once again open up a comment period, and that would have to be several months. And then the regulators would need to analyze the comments and then issue a final rule after that. One interesting factor is that there's something that called the Congressional Review Act, and that allows a new Congress to overturn a regulation put in place by an agency that was finalized less than 60 legislative days before it took office. So the interesting thing there becomes, if we have elections in November, we have a new Congress, the 60 days, it's legislative days. So that window actually becomes July. And so we're now in a situation where if you go reproposal and you have a fair amount of deliberating around taking on board the rules, and then you have to deliberate again, this actually could be thrown out in a new Congress. So there's a fair amount of chaos that's possible in this situation. But I think the immediate decision point is, are the regulators going to issue a final rule with amendments, or are they going to go to a reproposal? And so that needs to play out. And I think that's what we're looking at coming.
And switching over to Bank M&A, I think there was a poll question coming up. While that's coming up, I'll ask the question. Capital One is joining forces with Discover. That's obviously a sensitive deal. It took about 30 seconds for Elizabeth Warren to oppose that bill, that merger. So, I mean, there's clearly going to be some pushback there. But, Chris, you're in the M&A world. Jason, you're in the M&A world. What do you think? Do you think that we're going to see a new wave of M&A?
Well, Chris, before you go, do you think the timing with the limitation on late fees had anything to do with that merger? Maybe there's a little insider knowledge. It's interesting, right? It's a little game of, I think the Wall Street Journal called it whack-a-mole on banks, in terms of you can limit the fees, but the credit card issuers and banks are going to find a way to make it up somewhere else. Chris, your thoughts?
So the challenge is getting the regulators to approve mergers. We got PacWest and Bank of California done in record time. That's really the exception. We're, just seeing a few deals approved lately. So there's a little bit of movement, but it's still a very slow process. The key to M&A is going to be, will the regulators sort of, if you will, kind of bless things faster, to where a bank feels like they can announce a transaction, get it approved in 4.5, 5.5 months. That type of faster time frame would encourage consolidation. Right now, you're looking at 9 months on a good day, more like a year for a big transaction. I think that the smaller transactions that may not require Fed DC approval, that would be your local transactions approved in Dallas or Atlanta or San Francisco, those are easier to get done, and those are continuing to happen. The small community banks are still going to marry. That's where you have the most excess in terms of number of players in the industry. That's where I think you're going to see the majority of the change. At the big size, it really just depends on how this credit plays out. I think you have a lot of companies who can sort of go it alone for a couple of years, because we've seen from the mergers that have happened, like Truist formed by BB&T and SunTrust, that it's very hard. It's a hard transaction. Columbia and Umpqua and Oregon and the West Coast, that's been a hard transaction. It's not easy, A, to get it approved, and B, to actually integrate the two parties. So I think there's, it's a hard pill to swallow, unless you truly just want to get two companies together and are going to tough it out for that 2-year time frame to integrate.
Why are they struggling with integration, Chris? What common themes are you hearing?
It's personalities. It's getting two people to agree. I think it's more human nature than anything else. I think that the system side is getting easier and technology's better, so we can't use that as an excuse. I think it's more about just getting two people to agree. In the case of BB&T and SunTrust, you have BB&T run it on their own for a couple of years, and then transition to SunTrust. And it's a little bit like a book, but the Hatfields and McCoys running it each respective year. And it's just hard to do. And you eventually have to come together. They will figure it out at Truist, and I think they're further along now than they have been. And they've sold the insurance business, which gives them extra capital. That's a really good move for their part, to buy them time, and they'll continue to work it out. It's just clumsy, and I think that clumsiness is what a lot of other banks look at and say, "No, it's not for me. I think I'll pass."
Yeah, John. Chris is 100% right with the large mergers, with the regional mergers that are going to DC. There's integration problems. I would say he's also 100% right when it comes to more of the community bank size, in terms of it's a little easier, it's a little quicker. Shout out to St. Louis and Chicago Fed. Very, very, very deep dives into mergers, but they are very quick with the community bank size mergers. They are very expedient with the review. They give good guidance if you have preliminary discussions with them. I think it's not that the regulators are intentionally delaying mergers or creating these artificially long timelines. I just think larger bank mergers that are either opportunistic or synergistic or attempted synergistic mergers are tougher. But with the smaller ones, you tend to see the merger resolving some issue that the regulators had with one of the banks. Maybe there was no sufficient succession planning. Maybe there was insufficient amount of management or staffing, or there was an issue with earnings. And you're seeing these accretive mergers in the community bank industry that are really applauded by the regulators and tend to, again, I'm not going to say they're necessarily fast tracked, well managed, well capitalized. You're going to get some level of quicker treatment. But I have seen in my experience and on the mergers I'm working on, some pretty quick review when they're community bank mergers. Most times they're even quicker when you're resolving either an MOU with the selling bank, or you're just resolving something that the regulators had concerns with, if not rising to the level of MOU, but something they had concerns with the selling bank. And you have less integration problems because it's you have less overlap in terms of the mid-level management.
I brought up on the screen the new rule for essentially mergers in the OCC, and I know you've had a lot of thought and comments on this. What do you think about all this?
Yeah, and let me give a few thoughts on that, and maybe just swing back for a second on Cap One and Discover. I think those are unique banks given their footprint in cards and Discover's payment network. And I think with Capital One, capturing that potentially that payment network and building it into its overall card infrastructure and platform, I think that's a little different than even a mid or large size bank merger. And I wouldn't look at that as kind of an indicator of bank mergers, but I think that's got a lot of unique characteristics. The interesting thing about the OCC proposed guidance on mergers is it does a couple things, but one is it gives guidance in a more transparent way than has existed before, where it's been a little bit of a black box where you submitted merger application, you might get comments, and you might be able to kind of go through that process and solicit comments before, but there's a little opaqueness to it. And what this guidance does is it establishes criteria, and there's criteria that are both indicators that raise supervisory or regulatory concerns, as well as indicators that are consistent with approval. And essentially, they've got a list of items that would be a concern, or a list of items that would not be a concern and give the regulator comfort in a merger. So it provides a lot more transparency. And frankly, a lot of the items are things that you might expect. So in other words, if a particular bank has compliance issues or CRA issues, BSA AML issues, if it has lower ratings, things like that, that's not going to be favorable and will impede a merger. There are a few things, however, that were a bit surprising included in this, and I think those are worth noting. One is that if the combined institution would have over 50 billion in assets, that's an indicator that would likely not suggest approval. So I think what the OCC is, and it's, they call them indicators. So let's be clear, that doesn't mean a no, but you pile up enough of those, and that's going to impact the thinking and the process and the approval process. So, but what that's suggesting is that 50 billion becomes a bit of a ceiling, if you will, on size of mergers. The other one that I found a bit interesting was it talked about the target bank not having more than 50% of the assets of the acquiring bank. And what that actually would do is say that effectively mergers of equals are not desired any longer. And I think, you could maybe think about why that might be. And I think Chris and Jason were talking about some of the complexities of mergers, and sometimes, frankly, mergers of equals are harder because you go through that process and no one of the bank or management is, clearly in charge. And so you have this kind of, perhaps management succession process playing out, for years. So that could be a reason, but nonetheless, essentially mergers of equals were on that list as well. So I thought those were, interesting. I mean, there's another one in there, perhaps that, the very large banks or so-called systemically important banks are, basically not allowed to. And I think that's been kind of, discussed before in terms of, policy, clearly, an exception was made relative to, JP Morgan in the March event. But I think in crisis scenarios, perhaps they will, but not as a ongoing business as usual. But an interesting approach, providing more transparency to merger process and the thinking behind it. So I thought it's very interesting and definitely worth digging into.
I think Ed, certainly it's interesting. I am concerned about it because I'm concerned that there's going to be an overinterpretation of it. None of the indicators for, indicators against are really anything new to bank M&A attorney like myself. I mean, they're just very general indicators. One note I will say is that's looking at it from the applicant side. So when you start talking about Camel's ratings and whatnot, they're referencing that from the applicant side, which is the acquirer side, and not from the selling side. It's not unusual that a regulator is going to sort of promote a deal where a bank that is struggling is going to sell itself. I mean, they'll even suggest that to a bank. So I want to make that clear. The second thing I want to make clear is that every deal is different. And the concern I have with these rules is that there could be sort of a concern from banks of maybe we can't pursue this strategy because of these proposed rules. And I caution against taking that view. Every deal is different. These are very broad characteristics that the OCC has put out there, and your best bet is always to have a preliminary talk with the regulators, because they're happy to say no. They'll never say yes to you on the phone. But if they have significant concerns, they will raise those immediately with you on that initial call before you're even announcing anything publicly or before you're doing a definitive. So my experience has been the regulators have been very happy to raise concerns, and they'll raise them. And the concerns that they raise are always different in every deal because every deal is different.
Yeah.
They're not going to tell you we're going to approve this deal. And so the indicators for are probably more of the concerning aspects for me, that they would publish that as opposed to publishing, hey, if you fit into one, as an applicant, if you fit in one of these categories, you should probably not file. If they had left it at that, I would have been happier with that than trying to create a list of this is a more likely scenario that we would approve it and having that list published. That's what concerned me.
Let's talk about the hot topic in the industry, credit risk transfers. A credit risk transfer, in my view, is a tool to reduce risk on a particular portfolio, typically a residential mortgage portfolio or some type of consumer-like portfolio. And it reduces the risk-weighted assets on that pool as well. So if you had a resi portfolio, you'd go from 50 to 20% risk-weighted assets. If you had a commercial portfolio, which is rarer, but they've been done, you can go from 100% risk-weighted to 20%. Chris, is this a viable tool for banks, or is this kind of a fad?
Chris, you're on mute.
Thank you. Time will tell if it's a fad. I think it's an option that is a bridge to raising equity and raising equity at a later date. If you look at Merchants Bank in Indiana, they did one of these in the past year. It was timed really well. It bought them time. They didn't have to sell stock at a big discount like NYCB did. If you go back to PacWest and Western Alliance doing these trades, they were small but expensive, but it was done to limit the risk-weighted assets, as John said, and help their risk-based capital ratios in the regulatory channel. I think in reality today, banks ultimately may find that the regulators aren't exactly sure they like these CRT deals. I'm still skeptical if the Fed and OCC and FDIC like these. It is a tool. I think that a bank ultimately is going to raise capital. And so the question is, can they buy themselves time? And can they do these CRT transactions small enough so that the exposure, if they have to unwind them, is not too great. I think that ultimately it's going to be easier to keep things simple, raise capital, build reserves, fix the problems you have. A lot of this is really having the dry powder to deal with each loan workout separately and with the right solution. And that's ultimately what happened in 2009, 10, and 11. And I think that's where we're going to go. And I think because leverage is less, you'll have less losses, but I think you will have issues to deal with. So the question really is how you do it. I think CRT is just a tool. I think ultimately it's going to be easier just to have capital and do it on your own terms because you've got a big reserve.
You know, Chris and John, before people answer this question, I'm not sure everyone is as versed on credit risk transfer. Is it on this? Who's going to answer the poll? I mean, is it akin to like the old credit risk insurance that is really no longer offered by insurers? It's just kind of like Wall Street's answer to it.
Well, you get one of the benefits is it's basically, in a lot of cases, it's called the synthetic securitization. So there's actually a first loss piece ahead of you. Now, it's theoretically possible that you could exceed that, but think of it as an A and a B structure, and Wall Street takes the B piece. The cost on these things, I did hear a presentation from one of the firms, and they estimated about 3 basis points a month for a residential mortgage portfolio, which could seem expensive because you could simply pad your reserves and potentially recover those as well. So it's certainly an option for banks that are close to their risk-weighted asset limits.
John, one thing I thought was interesting, it was kind of very briefly reported, but apparently in the NYCB situation, they considered doing a credit risk transfer and actually had discussions with the regulators. And what was reported was that the regulators were not in favor of them doing that, and that they favored more of a traditional equity investment capitalization type approach, which is obviously the road they went down. So I think, I don't know that that's sort of definitive, but, one bank, in the heat of the moment and, could have gone down that path, investigated it, and they ended up going a different way.
Yeah,
well,
I was told that the.
Go ahead, John.
Yeah, I was told from someone in the know that they looked at the CRT with them and they jointly concluded it didn't make sense. Now, I don't know if the regulators also weighed in, but it seems to be that it would be prohibitively expensive to do it on the portfolio that investors are worried about, which is the multifamily portfolio. I mean, one thing I'll add is you can't cherry pick the assets in the CRT program. So, for example, some banks have said, well, why don't we take all our CRA loans and do a CRT? And that does not work, to be clear.
Well, don't you have counterparty risk? I mean, you're essentially, if the bank's taking the A piece and the investor taking the B piece, don't you still have to account on your books for some level of counterparty risk that entity that's holding the B piece is not going to be able to fund the extent of the loss, the credit losses, when and if they come? I mean, wouldn't a prudent bank do that?
Yes, that's where Barbara Streisand comes in. That's when the regulators call Barbara Streisand BS on that idea and go back to the need of more capital. So yeah. I think you're right, Jason.
Yeah. Well, it sounds like the response was overwhelmingly no. I suspected it'd be like that. But let's get back to exams. How have exams been? A year since SVB and Signature? Most banks have had an exam at this point in this new environment. What are you all hearing on how exams have changed in the past year?
Yeah, I think the heat's turned up on exams, and more scrutiny, more stringent, and more actions coming out of them. And to me, this is all kind of logical on that. You look back at what happened with SVB and Signature, and there were lessons learned reports there by the regulators themselves. And one of the things they said was that the regulators did not take sufficient action in terms of taking the issues that they identified, having that impact ratings for the different areas for the banks, and then having remediation actions, forcing remediation actions, and where necessary, enforcement actions, which really force that to happen. There's kind of a whole process, as many know, how that works. But clearly a lot happened in that environment. The banks really were to blame. But when the regulators were looking at their process, they said that they needed to be essentially more forceful in the examination process. And so I think we're seeing the outcome of that. I think we saw the OCC last year issued an updated bank enforcement manual where they added an appendix that talks about forcing actions and enforcement actions in various ways. And that really signaled that they were going to take it seriously. That's the OCC, the Fed, the FDIC, state banking regulators. They're all taking that approach. So I think it's, an environment that we're going to be in, for some time. Now, if you want to talk about different areas, I think there's different sort of hot areas, liquidity risk, obviously interest rate risk, CRE concentrations, BSA, AML continues to be hot. I mean, those are ones I point out, but the overall environment is pretty tough. And I think it's going to be that way.
Yeah, while you guys chime in, if anyone has any questions, please ask them in the meeting chat. Chris, Jason, what are you hearing about exams?
Yeah, well, I was going to say, there's a Wall Street Journal says bank rules have catching up to do, and I don't know if that's true. I mean, I think we're already overregulated the banking industry, but I would submit that from the regulator standpoint, they just say bank enforcement has catching up to do. And as Ed, I just echo what Ed said, which is that my experience with my clients is a lot of surprise coming out of their exams because they have either made small improvements or status quo, depending on certain areas, and they were downgraded. And they were downgraded because the regulators did not see significant enough improvement. So it wasn't, yeah, you've taken some steps and we're going to keep you at a 2 or a 3, whatever the case might be. We're going to drop you to a 3 or a 4 because you didn't get to where we wanted you to be this year. And Ed's right. I think that's a matter of state regulators, FDIC, Fed, having parity with the OCC and what their guidance was, and essentially saying, we got to step it up on these banks. If we tell them there's something they need to correct and they don't correct it by the next cycle, we're downgrading them. And that should just be the way. That should not, at this point, be a surprise, I think, for bank executives.
Yeah, Jason's right, and I think you've got more liquidity related in enforcement too, that you have to have your liquidity together. The same LCR, liquidity coverage ratio, that a regional bank or a national bank is doing, you have to have some version of it if you're a mid-size or community bank. It may not be an official LCR ratio, but it's going to be some buildup of what your liquidity is, where it's going to be, how you're stressing that liquidity, testing, particularly testing the Fed window. Now the BTFP is gone. All of that has to be done on a routine basis and documented, and your board has to be paying attention to this as well. So it's a very rigorous process, and banks just have to be on their toes. I've seen it before. I don't lose too much sleep over it, but I do think it's out there, and you just have to be paying attention. And it's ultimately why it's a challenging business right now, but it is going to make the industry stronger for sure as we go forward.
We're basically at our time. Bob, do you want to take us away?
Gentlemen, that was a great conversation. I appreciate it, John. It's always a great job. And John, very quickly, what is the next topic that you have planned in a couple months? Do you have an idea? I
think we're going to we basically have a rotating cast of 4 different groups. The next one will probably be a little more heavy, more geared towards CFOs, a little heavier on the security side, asset liability, and so on. But stay tuned. Most likely we'll have it in about 6 weeks.
Very good. Thank you all for joining us. This concludes today's webinar.
Thank you.
Thank you.